Trading futures and options on futures involves substantial risk of loss and is not suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility. And although this could be an equation for opportunity, it's also an equation for risk. So be careful. Only fund your futures trading account with risk capital. My personal definition of risk capital is money I could afford to lose, doesn't change my lifestyle, or overly stress me out. As human beings, we make bad decisions when we're under stress, so be in a good spot. Remember, micro contracts could be friends. Take it easy on the day trade margins. You get plenty of leverage without maxing out on those day trade margins on a regular basis. We'll be taking a look at a real-time simulated live NinjaTrader trading platform today, and none of this should be construed as trade or investment advice. Past performance not indicative of future results.
Good afternoon. Welcome to Technical Analysis Explained. I'll be your host, Tom Schneider, CMT with NinjaTrader. And here at Technical Analysis Explained, we like to go over in depth a topic from technical analysis that we may use in our trading. Something that Jim and Mike and I talk about on what we call our bookend shows, the opening range and bars closing. But I'd like to go a little bit more into depth to see why are these indicators, why are these concepts so important to traders, and why do we use them? So today's topic, I think, is something that's very near and dear to my heart. It's intraday support and resistance levels. These are very important for any trader to understand what the market participants might be looking at, what everybody else might be looking at. Not everybody else, maybe a portion of the trading group, but these are levels that might present themselves so that if you're aware of these levels, you might be able to use them in your trading. So we'll go through that. Let's take a look at the intraday chart I like to look at. So these will be indicators that are specifically for intraday charts. And as a day trader, as somebody who trades very short term, this is where I trade. I trade in an intraday chart. Now, you might use a different period for your intraday charts. We like to use 10 minutes here, but you could use these same studies on a 5-minute chart, a 1-minute chart. You could use them on a tick chart. But the same, what's really interesting about the studies I'll show is the values will generally be the same, regardless of what type of chart you're using, what periodicity of chart you're using. So let's start. I've got a 10-minute chart here. And if I were to look at this chart as it develops, this is 1 day's trading up until when we're looking at this chart right now, current. And the question is, what is this chart telling me about where there might be some important levels? Now, I can look at it kind of in a Monday morning quarterback, looking back as it's happened, and I can identify with trend lines, horizontal lines, maybe some array. I can look at trend channels. I can look and find these areas of support and resistance as they've already happened. And that's fine. We can always do that with any chart. But what if we had an indication or an indicator that could tell us about where there might be an important area based on previous days trading, current days trading? We'll see that. We'd want to use that, right? We'd want to know, because if there is a market moving event, I want to know where that market could move to. Now, with anything, I do want to reiterate that past performance is not indicative of future results. Just because we put these indicators on, the concepts behind them may or may not hold true, but it does give us a sense of where other traders might be looking. So let's start with I think, with the study that I think is one of the most important, and it's called, it's the previous high, low, and close bar. So if we think about trading, we look at a daily chart. You ask a trader, what's the most important points on that bar or on that candle? And I would think a trader would say something like, well, the high of that bar is important because that's where we ran out of buyers. There were no more buyers left. They did not want to pay more for that commodity. And that's why we have a high of a bar. And that doesn't mean it's, on a daily chart, on a weekly chart, on a 10-minute chart, on a 1-minute chart, the same concept applies. For that time period, we ran out of buyers. And that's why a high is made. Same thing for the downside, right? An important value on a daily chart is the low of the day. That's where we ran out of sellers. Sellers didn't want to sell lower than that. So the high and the low is instantly something that is important to know. Also, the close. Where did we end up? The market ends. This is where buyers and sellers agreed on that price at the end of the day. So if I'm looking at an intraday chart, I want to know where those daily prices are. I want to know where the high of yesterday was, the low of yesterday was, and the close of yesterday was, because that might inform my trading today. We might see support and resistance levels. Now, there is a study that you would need to do a little bit of searching for on the NinjaTrader ecosystem. And it's as simple as going to your search engine, typing in NinjaTrader ecosystem, and I'll give you the name of the study. It's on my study, on my chart right now. I go to indicators, and we'll see. It's called Prior Day OHLC. Now, if you do a search for that, you can find that page on the ecosystem that contains that study. You can download that to your platform and then import it through the tools page in your control center as a NinjaScript add-on. Once you do that, you'll be able to access that in your available indicators. Let's take a look at what I have here. So you will see prior day OHLC, and when you double click on that, it brings it down here, and it incorporates the symbol and the time frame because that's necessary for calculating those values. But how do I change that study? So when you first bring it into the configured studies area, you do need to configure it to give you what I think is the most optimal way to look at this. I'm not really concerned with the prior day's open. That isn't, I think the close being the most recent data point on that bar, right? It's the close of the day. That's the most important. High and low, of course, are important. But the open, where we opened yesterday, not really interested. So I uncheck show open. I calculate on each tick. That shouldn't be a matter. That shouldn't be a problem, I should say. But I just like to keep things consistent with my studies. I generally calculate on tick for everything. So I just change that. I remove the label because even though there's only one study on this chart, I want to use this with other studies. And if I keep the labels on all the studies, I'll get a lot of text up here that's just not necessary for what I do. Now, when I scroll down, I'll see the plots. This is where I think it gets interesting. So I changed the plots for the high, low, and close to be the same color. And the reason I do that is because I will distinguish between high, low, and close using what we call the plot style. So if we look at this, I'm going to blow up all three of those. I changed the color to something that might not clash or might not be the same as something else on my chart. Magenta seems to do fine for this. So I changed my color of the prior high, the prior low, and the prior close to magenta. And then I changed the plot style to, depending on which value it is, a triangle. So if it's the prior high, it's a triangle pointing up. If it's the prior close, I have the triangle pointing, prior low, triangle down. And if it's prior close, I have the triangle pointing to the right, indicating this is the close of the bar. I do change the width to 2 just to make it a little bigger. You can adjust these colors and the width size as necessary. So let's hit OK and see what that brings up. So in today's trading, I could see, and I'm just going to pull over a little bit, going back to the beginning of the session, which is right about here. I can see that I would expect, unless something is really unusual happens in the hour between the 5 o'clock close and the 6 p.m. open, starting the next session, I would expect trading to be right around that close of the day. And what do we see here? That the close held as resistance. And you'll see this sometimes. You'll see that the close might hold as resistance, indicating that maybe this is a bearish day. You might see that it acts as support, indicating maybe a bullish day. The question is, what does it do from that close? If it's holding as resistance, I might be targeting the prior day's low. And I know what that is because it's marked right here. Now, if we were on the other side of the close, I might be targeting the high if that were the case. But it didn't happen today. We never got above yesterday's close. This market is down from yesterday. It's not positive. And look how yesterday's low right here, it eventually got there, and it did find some trading around it, right? It traded down below, it traded above. It was like pivoting around that value. It acted as support for a couple of bars, and then still trading around it before it's finding a new direction. So this consolidation, or this could be the market chewing up orders that traders already know. They might have put in targets if they're bearish. They might have had stops in there at this level if they're bullish. But for whatever reason, traders putting stops in there, putting in targets there, might explain why the market stayed at yesterday's low for so long. So that's the opening range. I'm sorry, not opening range. Previous days, high, low, and close. Now, the study is called Prior Day OHLC, Open, High, Low, Close. So you can kind of interchange the previous and prior, but the study itself is called Prior Day OHLC, OHLC standing for Open, High, Low, Close. So let's go to the next study. We're on the topic of using yesterday's high, low, and close because they are important. Let's take what I would call maybe an extension or a derivative of that concept. And that is something called pivots. Now, pivots, this is something that have been around for decades. They were around before electronic trading. They were around before computers were used to plot data on charts. They were developed in the pits of the trading pits. And what that means is the people who actually traded and were down on the floor and doing the trading, they needed to have a way to understand what might happen for the next day. When they came off that floor and they looked up at the big board and they saw for their market the high, the low, the close, those three important points, how could they take that data and anticipate a wider range than just today's range? How could they use that information to their advantage and calculate levels that extend beyond yesterday's high and low? Well, what's really interesting is whoever developed this, and I don't know if there's an author, I don't know if it's been determined, but these pivots were calculated using the high, low, and close from the end of the day to be ready for the next day. It's a simple average. So let's take a look at the pivot. The pivot right here is 43.96. This is the average of the previous day's high, low, and close. You just add up the high with the low with the close and divide by 3, and there's your pivot. So that's one piece of the puzzle. It's a pretty important piece. There are support and resistance levels around this level, this pivot level. And if I shrink this up, you'll see what they look like. Now, today's trading range isn't that wide. So these pivots, if yesterday is turning out to be a wider day than today, these pivots will be these levels will be pretty far off. You can see here, I've got my pivot in the middle. I've got R1 and R2 and R3 up here. And I've got S1, S2, and S3 down here. Now the S stands for support. The R stands for resistance. But they are just labels. What do I mean by that? Well, this R1 will always be above the pivot. It will always be below R2. It's got a place in its hierarchy, R3 at the top, S3 at the bottom, but it could just as easily be used as support as it can be used for resistance. Just look at this right here, S1, support 1. We had a target. When the market starts backing off away from this pivot, we had a target, and that target is S1. Now that we failed S1, S1 failed to hold, we have a target in S2. But look at this. This market did try to get above S1 again, and it failed. S1 acted as resistance. So these levels, despite whatever they're being labeled as, they can act as support and or resistance. Now, on a day like today where there might not be a lot of news, these pivots are interesting. These pivots are interesting because there might not be enough volatility to get to multiple pivot levels. But when the market does move, and if you've never seen pivots, you might not know why the market starts trending in a direction and accelerating in a direction, either up or down, and then all of a sudden stop at a very interesting level. If we look at these values, 43.70, 43.39, 42.81, they're not psychological levels. They're not clean numbers. They're kind of whatever number the calculation is. Sometimes you might have seen, hey, why did this number just stop at 43.39 or whatever it is? Well, it's because other traders know about pivots and they might be putting their orders in. And so somebody might say, if it gets down to the second pivot level, I'm going to start going long, or I'm going to get out of my short. Maybe I'm going to turn around and go long. I think there's support there. And so that's where that might explain some activity around it. These are really interesting to look at when it's an event day, when it's a Fed announcement day, even the ECB. I've seen cases where there's a surprise. Fed on Wednesday announces the rates, and it's not a surprise, and still the market moves 3-4 levels. And then the next day, the ECB comes out, and it is a surprise. And it moves 5 or 6 pivot levels. But when it gets to that level, it hangs out there for a while, right? It might hang out the rest of the day at that level. And that's because other traders know this. Now, how do we determine these other pivot levels? Well, as I said before, this pivot itself is the average of the high, low, and close of the previous day. This distance, this is R1 right up here, and this is S1 right here. The difference between these two lines is the previous day's range. If you were to subtract yesterday's low from yesterday's high, it'd be the same as subtracting S1 from R1 on the next day. And the same can be said for the pivot to S2. That distance is yesterday's trading range. And the same can be said for the pivot to R2. That's yesterday's trading range. So they're using yesterday's boundaries to project possible extreme or more extreme values. R2 to R3, yesterday's trading range. S2 to S3, yesterday's trading range. So it's not a lot of magic. It's not a lot of secret sauce kind of stuff. It's kind of logically, it's pretty interesting. If we have a day that's really, event filled, or there's one event, but it's really takes the market by surprise. Well, maybe it does move the market in multiples of yesterday's trading range. And here are some targets. Let's just take a quick look at the indicator itself. This is available in your NinjaTrader 8 platform. It's under the study pivots, and I've already added it down here. And I use daily bars, so it's using the high, low, and close from the daily bars. It's just what I like to do. The width I extend, so I like to see the pivots across the whole chart. If you leave it at the default, it shows recent data, maybe 20 bars worth of data. It just marks it. Well, these pivots don't change. They don't change during the day. That's why traders could come off the floor and calculate them the night before they trade the next day and know where they might put in some protective orders. Same thing. These values don't change. So I'm just going to put that width as 150. It might be different if you use a 1 minute chart, or you might have to put in more of a width. I think it's done on bars. So just play around with that to see which width works for you. I calculate on each tick, even though I don't need to. I do that as a kind of a habit to make sure all my studies calculate on each tick. And then I do change the plots. I like to make my resistance levels red because they're a barrier to upside potential. They're resistance. I like to make my support levels green because they support the market. That's kind of bullish, right? Now, it doesn't mean that that S1 can't be resistance and that R2 can't be support, but these are the colors I like for my lines. So those are pivots, and I think they might explain some activity that you might not otherwise have seen without them. I like to think of it as like if you're in a forest, and you're in the middle of the forest, and somebody says, okay, you got to get out of the forest. It's much easier to know where to go if you have signposts saying exit this way. Well, this is somewhat similar in the sense that these might be signposts to where the market may go. Let's take a quick look at the next study called opening range. And the opening range is something that I've looked at. Opening range is a little bit fluid. It's something that you can adjust, that you can customize. I tend to look at a 30-minute opening range. So when we're talking about opening range, you can put it anywhere on the chart. You could do it for the open of the session. You might do it for a different part of the curve than I do. I like to look at the New York Open for stock index futures. For crude or for gold, I like to look at the traditional NYMEX or COMEX opens. Those are earlier than the New York Stock Exchange. So this is one study where you may have to either make a separate chart for the different asset classes that trade at different times, or just understand that the range that you're using is something that is unchangeable. It doesn't adapt with the instrument. You would have to change it. But what we're doing here is we're marking the high and the low of the first, in my case, 30 minutes. Now, I know my friend Anthony Crudelli, he looks at a 3-minute chart and he puts his opening range on 3 minutes. Although he doesn't use the study, he uses horizontal lines to do that. But the same concept. He wants to know what the high of the first 3 minutes of the day were, and of the trading day, and not the session, but the regular trading hours. He wants to know what the high and the low are, so he can use that as guides. I use 30 minutes. And the reason why I use 30 minutes is at some point, what we're trying to do is we're trying to see, well, if we get outside of the opening range, most likely we will not finish on the other side of the opening range. It kind of helps with bias. And we extend another 30 minutes to 60, and some people look at a 60-minute opening range. You don't gain much more. You give up 30 minutes maybe of trading or using that concept for just a couple percent probability points that the market will close where on the side of the opening range that it broke through. So in this case, what I'm looking at for opening range is a couple of things. I'm looking for bias. When we establish the opening range, here's the high of the first 30 minutes in red, and here's the low of the first 30 minutes in green. When we closed outside, oh, I'm thinking, well, maybe it is a bullish day, but we turned around real quick, and now that opening range low seems to be kind of preventing us from getting back into the opening range. We tested it here. We tested it here. This opening range low acted as resistance because we're below it. Now, if we were in the opening range and it was a range-bound trading day, we might see that the opening range low acts as support. but that's not the case here. Today, it acted as resistance once we closed down below it. You could say that it acted as support up until we had this turnaround. It's supported, okay. We traded down below it, but we didn't close below it, and we didn't quite get to it to the next bar, and we just got to the bottom of the bar, just right at that opening range low, but then it fell through. So it did act as support for about, I don't know, 50 minutes or so. And then it switched to resistance. And we see that a lot, right? Support becomes resistance. Resistance can become support. We'll hold these lines the entire day. And in fact, into the next session. You can see here are some bars from the previous day's opening range. Now, how can we adjust that? Let's just go to indicators. And I'm going to go to my opening range indicator. The one thing we want to make sure is our start and end time are correct. I'm on the East Coast, so I'm using East Coast time period, and I'm using 9:30 to 10. That's the first half hour of the regular trading hours. I also changed the highline color and style, make it a dash dot, so I know exactly, if I see a dash dot, I know it's the opening range high. If I see a dash dot, green dash dot, I know it's the opening range low. I changed the width as well. And then here you could put in a midline too. You have a box for show mid price line. I don't do that. I don't usually use it that way. But that's it. And I do update on each tick. So when we get a new bar, we will get an extension of those lines to the new bar. So that's the opening range. Very important. Last one is order flow VWAP. Now, this is a little different because these levels, they change. They do not hold for the time period after which they're calculated, like pivots, like the previous day's high-low close, or the opening range once that's established. Those values don't change, and that's why they're nice, right? VWAP is a little different, but they do act similar. They act similar in that these levels can act as support and resistance. So this is the order flow VWAP study. If you don't see it in your indicator list, you might have to contact NinjaTrader or contact your broker to see how to get that package. It is not part of the basic NinjaTrader 8 platform, but it is very important. Order flow tools for a trader, very, very informative. And so that's what this is. Now, the VWAP itself is this red and green line. The coloring is based on where price is in relation to that line. When price is below the VWAP, it's red. When price is above, it's green. What is VWAP? Volume weighted average price. It's basically the average price of every contract traded today. So when each trade happens, the weighting is determined by the number of contracts traded at that price. So if there was a trade where, let's say 10 contracts were filled at 43.90 and one contract was filled at 4,400, the average would be weighted towards that 43.90 price because there were 10 times as many contracts filled there. It's not a straight average where you split the difference. So this VWAP changes with price and with volume as the day goes on. Now we have these bands around it. These are standard deviation bands. One standard deviation, ideally, concept is 67 to 70% of the trading should happen between these two bands. But the market being what it is, doesn't always happen, right? It can go to the second standard deviation band. Now we're talking 95, 96%. Doesn't always happen. Look at this. We hit the third standard deviation band. That's an extreme move. But these bands can act as resistance. Sometimes it doesn't, but look at here. There is a nice stretch where the VWAP acted as support. And every time we touch it, we went back to the VWAP standard deviation 1. Tried to get to the standard deviation 2. Didn't quite make it. It tests a VWAP again, acts as support, tests it again, acts as support. Finally, it broke down. And look what happened. Market came back to VWAP. Resistance, 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 breakthrough, and then maybe support for one candle right here, and then a breakthrough again. So what is similar about order flow VWAP is that it doesn't really matter if I'm looking at a 1-minute chart or a 10-minute chart. That value will be the same because it is an average of everything traded up until that time. So let's put it together and see what a chart looks like with all of these levels. Not too intrusive, right? Not too overwhelming. I can tell right away where yesterday's close was, 4,400. I can see where yesterday's low was, right here in this magenta label, which is actually obscured by my VWAP band here. Notice that this yesterday's low, this dotted line here is yesterday's opening range low, and that was the day's low. So the opening range was the low of the day. Interesting. We've got pivots. We've got to see right here. Here's the pivot. Here's S1. If I want to see where this could go to, I've got some targets down here. I've got a VWAP band, third standard deviation here. I've got S2 as support. And then if we do this even further, we can see where S3 is. So to sum it up, there are multiple ways of seeing where we might find some areas of support and resistance. And with these studies, you can cover more than just yesterday's trading range. You can cover multiples of yesterday's trading range using these studies. Combine that with yesterday's high, low, and close with the opening range and with the VWAP bands. You have plenty of areas to say, this is where the market could go and find some resistance. This is where the market could go and find some support, and put in your targets and stops accordingly. With that, I'm going to wrap it up. I want to thank you, the viewer, for watching. Thanks to Mission Control for producing this show. And we will finish the day with bars closing at 3:15 with Mike Burke. In the meantime, have a great trading day.